In 2023, the Tokyo Stock Exchange sent a letter to every listed company trading below book value. The message was unambiguous: fix your capital structure or face consequences. By 2026, that letter has triggered the most significant reform of Japanese corporate governance in a generation. This video examines what Japan's corporate reform actually means for investors and why it matters far beyond Japan's borders. For decades, Japanese corporations were famous for two things: exceptional operational quality and extraordinary capital inefficiency. Companies accumulated cash, cross-held shares in each other through complex keiretsu structures, and generated returns on equity that embarrassed their global peers. The numbers were stark. In 2022, more than half of all companies listed on the Tokyo Stock Exchange Prime Market were trading below their book value, meaning the market valued these businesses at less than the sum of their assets. In any other major market, this would trigger activist pressure or acquisition. In Japan, it persisted for years. The reasons were structural. Japanese management culture prioritized stability over returns. Cross-shareholdings insulated boards from shareholder pressure. And the concept of maximizing shareholder value was viewed with genuine cultural suspicion, seen as short-termism imported from the West. The TSE's 2023 intervention changed the calculus. For the first time, the exchange itself was publicly pressuring companies to address their price-to-book ratios, improve return on equity, and engage meaningfully with shareholders. The era of passive acceptance was over, but the reform didn't stop at the exchange level. It reached the highest levels of government. Prime Minister Kishida's administration integrated corporate reform into the new capitalism agenda, providing the political tailwinds necessary for change. Major corporations began the painful but necessary process of unwinding cross-shareholdings, releasing billions in trapped capital back to the market. This led to record levels of dividends and share buybacks, signaling a fundamental shift in how Japanese boards view their investors. The market responded. The Nikkei's historic rally wasn't just about yen weakness. It was a vote of confidence in a new Japanese corporate identity. For global investors, the Japan discount is narrowing. The risk is no longer inefficiency, but the cost of being underweight a transforming market. Japan's management culture is undergoing its most significant shift in a generation. The transformation of the world's third largest economy is just beginning. The 2023 mandate was the spark. By 2025, the results are no longer just aspirations, they are quantifiable. Japan's corporate sector has moved from form to substance. The impact is visible in the data. Over 90% of prime market companies have now disclosed reform plans. Average price-to-book ratios have climbed from 1.1 to 1.4, while return on equity has reached a generational high of 9%. Shareholder distributions have reached unprecedented levels. In fiscal year 2024, share buybacks hit a record 16 trillion yen, while dividends surged past 20 trillion. Japan's payout ratio now rivals the S&P 500. This marks a historic convergence with global capital standards. Success stories are emerging across the Nikkei. Traditionally conservative Kyocera announced a plan to sell 1/3 of its massive KDDI stake, worth 1.6 trillion yen, pivoting capital back into its core semiconductor business. Similarly, Toyota Industries is unwinding its complex Denso holdings, signaling a victory for transparency and a more rational approach to group structures. Global capital is following the reform. In 2024, activist funds purchased a record 1 trillion yen in Japanese stocks, moving from hostile combat to constructive board engagement. The roadmap for 2025 is clear. Starting in April, prime market companies must publish disclosures in both Japanese and English simultaneously, ending the Japan discount on information. The focus is shifting from simple disclosure to board effectiveness. Investors are now pushing for independent chairs and lead directors to provide genuine strategic oversight. Japan is no longer an efficiency laggard. It is becoming a strategic destination for global capital. The transformation is real and it is accelerating. The foundation has been laid. As we look toward 2030, Japan's corporate reform is entering its most critical phase. The transition from form-based compliance to substance-based value creation. The next major catalyst arrives in mid-2026. The revised corporate governance code will demand stricter justification for idle cash on balance sheets and mandate that financial reports reach investors weeks before annual meetings. The 2025 Stewardship Code will further normalize collaborative engagement, making it easier for institutional investors to speak with one voice on governance issues without regulatory friction. Governance is also becoming more diverse. Under the government's big-boned policies, Japan has set a clear target. At least 30% of executive positions at prime-listed companies must be held by women by 2030. The market for corporate control is awakening. Normalized, unsolicited bids and M&A are becoming powerful tools of discipline, ensuring that underperforming boards can no longer hide behind traditional structural defenses. Domestic retail flows are providing a massive tailwind. Reforms to the NISA savings accounts are designed to mobilize 2,000 trillion yen in household financial assets, half of which is currently sitting in cash. The result is a fundamental re-rating of Japanese equity valuations. As governance risk premiums decrease, the long-standing Japan discount is steadily eroding, rewarding those who recognized the shift early. By 2030, Japan will likely no longer be seen as an occasional trade, but as a permanent, highly efficient core allocation in the world's most sophisticated global portfolios. The initial wave of Japan's corporate reform focused on the Nikkei giants, but the next frontier of value is deeper. We are now entering the alpha wave, a structural re-rating of Japan's small and mid-cap universe. By 2026, a massive valuation gap has emerged. While large caps have seen their prices reset, small caps still trade at a significant discount, often below 1.5 times book value. This is the low-hanging fruit of 2027. Stricter TSE listing criteria are triggering defensive governance. Smaller firms are aggressively engaging investors to boost market caps above the 10 billion yen threshold, turning regulatory pressure into a catalyst for share price appreciation. Retail power is reaching a historic tipping point. The new NISA program is projected to hit the 100 trillion yen milestone by 2027, transforming millions of Japanese households from savers into long-term shareholders. The mindset is shifting. The historical pattern of retail selling during rallies is breaking. Domestic investors are increasingly adopting a buy-and-hold strategy, providing a stable, multi-trillion yen floor for the market. Institutional managers are pivoting. Global firms are doubling their investment pace in mid-sized companies, seeking governance arbitrage, identifying undervalued firms and actively pushing boards for better capital allocation. The hunt for alpha is becoming high-tech. Sophisticated managers are using proprietary AI to process Japanese language disclosures and patent filings, uncovering undervalued gems that traditional screens simply miss. This re-rating is being accelerated by a record wave of M&A and management buyouts. Hostile takeovers, once a cultural taboo, are becoming a standard tool for corporate discipline and value realization. The message for 2027 is clear. The most significant returns will no longer come from broad market indices, but from the specialized, high-governance champions of the SMID universe. Japan's corporate renaissance is not a cycle, it is a generational structural transformation. Stay ahead of the renaissance. For more deep dives into Asian financial trends, visit propertynewsasia.com.